China's recent economic stimulus measures have created renewed optimism, providing a potential tailwind for the iShares China Large-Cap ETF. This is now entering a historically strong period. The instrument offers diverse exposure to the largest Chinese companies across sectors like financials, technology, and energy. And from October the 1st through to December the 2nd, it's shown a 34.57% annualized return with a greater than 70% win rate and an average return of over 5%. So this favourable seasonal trend, coupled with China's fresh stimulus, may present an opportunity for investors. There was a range of stimulus measures announced, with the People's Bank of China recently rolling out significant measures with a 20 basis point reverse repo rate cut, 50 basis point reduction in the reserve requirement ratio for banks, injecting 1 trillion Chinese yuan of liquidity into the economy, a big property sector boost with lowered down payments on second homes and existing mortgage rates being reduced. And on top of this, there was another 300 billion Chinese yuan relending facility and a 500 billion Chinese yuan stock liquidity swap facility, all introduced to support stock buybacks and market liquidity. And this did trigger a strong reaction on the day it was announced, with China's 50 up over 8.5% at one stage. Now, just taking a look at China 50, you can see here with the ETF that as long as you stay above this trend line, technically breaking above that on the weekly chart, it's not unreasonable to expect a retest up to that 33, 34 region, and any retracements back down to 28 look absolutely fine for dip buys as long as that trend line stays, as long as price stays above that trend line on a weekly closing basis. So technically there's a simple way to manage risk. Stops can just be placed underneath the pre-news level. Remember, don't just trade it. Season exit. There are always risks with outlooks, and the major risk with this outlook is that China's economy still faces significant headwinds despite stimulus efforts. There's slowing demand and a weak property sector, and if economic data continues to disappoint, the stimulus may not be enough to support sustained growth. Furthermore, global economic conditions will be very important, particularly US monetary policy and geopolitical tensions. All could also impact Chinese equities. So as always, there are some significant risks swirling about. Do sign up here at SeasonX for literally thousands more great insights on seasonality just waiting to be revealed.